If the Federal Reserve pushes the world into a deflationary spiral, gold is not going to achieve that potential in terms of absolute price very, very soon, because all asset prices are relative to something. And we may actually see something that looks illogical, but that makes sense on a relative basis, which is the strengthening of the US.
Gold prices edged lower on Monday as the US dollar gained some ground in the run-up to this week's inflation test. Daniel Lacalle, the investment manager, believes that if the Federal Reserve's actions persist in pushing the global economy into a state of deflation, the potential of gold to reach its highest possible value in terms of price might be hindered. In his perspective, the worth of all assets, including gold, is intrinsically tied to the context of comparison with other currencies or commodities. According to Lacalle, the significant problem gold faces in achieving its price potential quickly is its liquidity aspect. In times of economic turmoil, like another financial crisis, there are concerns about counterparty or prime broker risks associated with holding ETFs in gold or other assets, like the Nikkei or S&P 500. In such circumstances, Lacalle believes owning physical gold could be a safer option as it does not depend on intermediaries and provides a direct hedge against market uncertainties. Speaking with Andrew Maguire, Lacalle also pointed out the global impact of the depreciation of fiat currencies compared to the US dollar and gold. Many fiat currencies are losing their value relative to the US dollar, which means it takes more units of these currencies to purchase the same amount of dollars. This situation makes gold more attractive to safeguard against the devaluation of currencies, as gold tends to retain its value over time and is considered a store of wealth. Gold is a scarce commodity that has maintained its value against the rapidly depreciating value of fiat currencies, making it an attractive candidate against the US dollar. We will now bring you clips from Daniel Lacalle's interview with Kinesis Money. But before we do, if you want more videos like this, ensure you smash the subscribe button and turn on the notifications bell for more videos. Thank you, and enjoy the video.
And the big problem that gold has to achieve its price potential steadily and quickly is liquidity. I think that it's the liquidity aspect that makes gold take longer to generate its, let's say, price potential relative to what we see in the economy. However, what is interesting at the same time is not to look at gold in US dollars alone.
Yeah.
Is tell this that we're discussing right now to anybody that is watching us in Argentina or in Venezuela or in Iran or in Turkey, is the number of fiat currencies that are completely being destroyed relative to the dollar and to gold, and that have no other alternative. And I think that is what matters to me, is as I look at the global monetary picture, is that if I had 2% of global currencies in destruction mode, in internal destruction mode, 25 years ago, right now that figure has risen to about 15 to 16% of all global fiat currencies. So if we look at what is happening globally, we look at it relative to the dollar without understanding that the dollar obviously is losing purchasing power. The inflation in dollar terms is very elevated, but at the same time, that is happening to many other currencies. Tell that to the Japanese, who were told that they had found the magic formula that would make their currency strong and at the same time increase massively their financial and fiscal imbalances. So I think that is what's going on, and the liquidity aspect is what, let's say, prevents gold from reaching the potential that it could reach based on the fundamentals that you outlined as quickly as we would imagine. The Fed doesn't look at the price of gold at all, And to the extent, and I've had the pleasure of meeting numerous members of the Federal Reserve and other central banks. None of them even consider gold at all. They may talk about housing, they may talk about stocks, they may talk about bonds, but never about gold. And it comes back to what we were saying before. They stopped talking about monetary aggregates, or at least considering them, and they stopped as well thinking about gold as money, or as an asset to compare, as you very well did right now, with outstanding levels of debt. So what is going on is basically a level of denial about what is going on and the diminishing returns of expansionary monetary policy. Okay, uh, if we look at money in history, what has happened in the last 20 years is an anecdote. It's nothing, no? So it's so frustrating to see academic works and central bank works talking about what is going on in the monetary system, looking at 30, maybe 20 years maximum, which is irrelevant. That's why they made the mistake of saying that increasing money supply would not generate inflation, because the period of time that they looked at to analyze that causation was so small, was so absolutely minuscule compared to history, that it was statistically irrelevant and definitely, from an empirical perspective, completely ludicrous.
Lacalle discusses the risks associated with owning physical gold, mainly focusing on the difficulty of keeping it safe and secure. Throughout history, there have been instances where physical gold was confiscated, especially during times of financial repression. Despite this potential risk, Lacalle points out a notable shift in the behavior of central banks towards gold. In the last 2 years, central banks have been purchasing gold unprecedentedly, which was previously considered unlikely. According to the World Gold Council, WGC, central banks acquired 386.9 metric tons of gold in the first half of 2023, surpassing any previous January-June period since 2000. The surge in demand for physical gold is attributed to concerns surrounding the vulnerability of digital assets like bank accounts. There have been instances where central bank accounts were frozen due to political reasons, creating apprehension among central banks about the possibility of losing their digital wealth. In response to this uncertainty, many institutions are turning to physical gold as a more dependable store of value. Lacalle clarifies that embracing physical gold should not be seen as a return to outdated practices. It reflects a desire for more tangible and trustworthy wealth protection. Let's get back to the interview.
The only risk that you have with physical gold is obviously the fact that it is physical, that it's difficult to store, and that, as we have seen, unfortunately, at least once in history, is that it can be confiscated. And we should not forget that in an era of financial repression. But what I think is very important about what you just said is the underlying trend of what is changing in the central bank world relative to gold. We have seen for 2 consecutive years a record purchases of gold from central banks that was actually even considered as ludicrous a few years ago. A few years ago, you might remember that there was an entire debate saying that it made no sense for central banks to hold gold as a reserve. And what we're seeing is the opposite, which is it truly interesting, because it means that something is changing. The Chinese central bank does not trust the US dollar entirely as its main reserve base. Same thing happening with the Russian central bank, with many other central banks all over the world. So on the one hand, we're seeing a massive purchase of gold from central banks. On the other hand, the move to physical gold is strengthening relative to the belief that I, for example, lived a few years ago, 10, 15 years ago in the market, where what people said is basically what you have to do is buy an ETF, everything else doesn't matter, no? And the reason why we are seeing such massive purchases of physical gold is because a lot of central banks, after the decision to freeze the accounts of the Russian central bank and other monetary measures because of political purposes, etc., are basically starting to get exceedingly concerned about the possibility that the units of digits that we own in our accounts can vanish very, very quickly. No? So a lot of people that I speak with say, well, but this would be like going back to the old times, having coins, in the basement and all those things that have nothing to do with modern money. No, it has to do with real money. Huh? Real money is not a paper or a digit, or is something that we can exchange for goods and services in a difficult period of time. And if anything, all this process is showing that gold is real money and that everything else is credit, as J.P. Morgan was, I believe, quoted saying.
Gold's value is expected to experience fluctuations due to various economic and global factors. As central banks implement their policies and market sentiments fluctuate, the demand for gold as a valuable asset may continue to evolve. Is gold's potential as a safe haven asset affected by deflation, liquidity concerns, and currency devaluation? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.